Hi everybody, it's Neil. I just thought I would check in and give you my view of what's been happening with the market over the last couple of months. You know, October is usually thought of as a frightening month and a bad month for stock market investors. But this October was actually pretty encouraging. Actually, the October recovery from the August and September drops was impressive, to say the least. And that's one reason why I really don't like to rely on truisms to guide investment decisions, because those truisms are rarely consistently true. The U.S. indexes had their best month in 4 years last month. The Dow and the S&P 500 each gained more than 8%. The NASDAQ rallied over 11%, which isn't bad at all. Foreign markets were also up. They gained about 6%, but they lagged domestic equities. And that's another reason why I'm glad that we follow the market leadership rather than hold on to a static allocation. Actually, the only people who lost money in October were those who were understandably frightened, but gave in to their fear and they abandoned their discipline, they sold out, they locked in losses and missed out on the recovery. Fortunately, we weren't among that group. Let's take a look at what might be ahead for the economy. Actually, it depends on who you ask. Economic data is sending out mixed messages. On one hand, the economy has been expanding for 6 years now, and that's really a long time by historical standards. Some people point out that the global markets are slowing down, the global economies are slowing, and they make a reasonable case that a slowdown overseas would impact our own economy sooner or later. And if that happens, it would result in lower equity prices. Other people point out that our current exports to China represent less than 1% of our GDP, and our economy is strong enough to overcome any softness overseas. So it's hard to tell. People have different opinions. Let's take a closer look at why the market recovered last month to see if we can find some clues about what may lay ahead. The market started doing well on October 1st, and that's when publicly traded corporations started reporting their quarterly earnings. Those earnings reports have been good for the most part. Unemployment numbers are also encouraging. You'd have to go back to 1973 to find a time when fewer people were filing for unemployment. But the skies aren't completely clear. One thing that concerns me is corporate revenues. Companies have been able to generate nice profits, but sales aren't growing as they should, and our overall economic growth is just really creeping along. It's not really dynamic. And without real dynamic revenue growth, soon profits are going to be harder to come by, and that could impact the market and our holdings. Revenue is something I'm keeping a very sharp eye on right now. Let's move on. The last several months haven't been easy. We've seen the market drop a total of 11% from high to low so far. For most of you, this was uncomfortable, but not really a problem. We've been through this before, and we'll go through the market corrections again in the future. In fact, a 10% correction is something that you almost have to expect every year. On average, you get one of those every single year. But it's important to keep things in perspective. Some radio personalities and TV personalities are telling investors that 2015 was going to be 2008 all over again. And so far, it hasn't been. What helped us greatly is that we stuck with our market approach and ignored that noise. Market declines similar to those we saw in 2008 are very rare. They can and do occur, but it costs investors a lot of money if they're constantly invested as if a permanent, devastating market drop was just around the corner. My experience tells me that it's far better to simply pay attention to the market, adjust holdings to the strongest relative funds, and make adjustments as required despite our feelings. Again, this approach really paid off for us so far this year. Now, even if you were okay with what happened in the market over the last few months when it declined, it's important to understand that those declines are part of investing. But it's even more important to be rational about the market and to keep things in perspective. Now, if that perspective escapes you in choppy markets, it's fine. It might mean that it's just time to get together with me to discuss ratcheting back on your equity in the portfolio and adding more fixed income to reduce some of that risk and volatility. If that's something that you'd like to discuss, just drop me an email and we'll put something together on the calendar. And if you have other questions about other financial matters that I can assist with, please let me know. It continues to be an honor for me and my team to be of service to you and your family. Thanks a lot. Hope to hear from you soon.